called Corporate Venture Capital. Let's talk data, numbers, and trends. Our panelists are Faris Akkad, Regional Managing Director at Meta. Faris has been nominated in the Forbes list for Global Meets Local, and he's a board member of CAFU, Kidsonet, and Enhance Fitness. Antonio Avitabile is Managing Director, Europe, Sony Innovation Fund. He's running the CVC activities of Sony in EMEA and is running the Corporate Development Division of Sony Semiconductor. And this session will be moderated by Mike Gozzo, ADA's Chief Product and Technology Officer, angel investor and advisor at Bessemer Venture Partners. He is a serial entrepreneur specializing in AI customer service automation. Welcome.
All right, good afternoon.
Hi.
Is on? Hope it's on. No? Is it
No.
on? Okay.
Testing, yes.
I think
Yes, we're on. Okay,
yeah,
great.
yeah.
Okay, so Fares, I'm not on? I'm on now, yeah. Fares, Antonio, good afternoon. Nice to see you. Let's kick things off. We don't have that much time today. So to first off, maybe we'll start with Fares, then have Antonio comment. How do you see the role of corporate venture capital in today's changing funding landscape? A lot of sources available for entrepreneurs, a lot of private funds out there backed by institutions and private LPs. What's the role of corporate venture in all of this?
Thanks for having me in, and it's good to be here. Look, overall, I think there is a maturity in seeking funding that, depending on the kind of startup, sometimes, obviously money is important, but the strategic support that an industry, a pillar of industry in a particular sector can play. In some cases, it's an absolute necessity. In other cases, it's a nice to have, but it's definitely a value add. And if you have options in terms of which funding to take, I think the most basic one would be just money. I think the ability of an institution that might have direct or ancillary interest in the sector can really unlock a lot of potential much quicker. From know-how to connections to distribution, you name it. That's one. And then the second thing is the appetite of a corporate investor to invest at a large scale in a particular industry that could be quite existential for them is much higher than any venture VC that's just looking for returns.
Yeah, very similar to what Faris mentioned. So I think companies, they don't only need money, they need competencies. They need actually people with some experience to kind of advise the founders and explain them, how to deal with big companies, because usually big companies are their first customers, and dealing with them as a small startup, it's quite tricky. I've seen many times actually small companies selling their soul for 1 or 2 million to their first customer. So that type of balance and equilibrium, I think, is super important, and I think CVCs are in the best position to advise because we understand how big corporate think, so I think that's one of the key aspects, I think, and that it's, we can bring into the table. So it's not only money, and also domain expertise. Actually, we tend to invest only in areas that we really understand. And so we are in the best place to tell them and to advise them on how to deal with their customers and how to deal with problems and also how to decide and what kind of decision to make in order to kind of be sharply focused and be capital efficient and so on. So that's basically the key.
That actually brings me to an interesting point, and I kind of want to double click on that, even though it wasn't one of the questions that I proposed initially. One of the advantages, like you said, of a CVC in your sector is that know-how and that expertise that you can get. But isn't that a double-edged sword as well for founders that are looking at corporate venture capital as a source of funding, potential for conflict of interest, worries about information rights? Like, how does a founder in this space really think about the double-edged sword that a corporate affiliation can lead?
Look, it's a very valid question, and in my experience, you can differentiate an experienced founder from a new founder by the way they approach this topic. A new founder who comes in very paranoid, NDA, this, I'm not going to tell you, you're new to the game. Because I think part of the proposition is you have to come in understanding what you can offer and why is it of value to your investor. And in the basic case of where you're seeking money, your case has to be very clear on what's the return, what's the potential, where the money's going to go. But in the case of an institutional investor, it's less about the money and more about why you should leverage me than try to build it yourself, which is the primary concern. Which, if you think of someone at our scale or anybody else's scale, any business that is not in the hundreds of millions is not something we're going to play in. And so understanding that there is that room of a very profitable kind of space without having to be basically in direct competition. Second is there are certain models that need to be a lot more agile and nimble and don't work in very large structures, right? So there is a proposition where you can position it there. If you're going into a meeting where you're still not sure, I think you need some homework to do. If you're still not sure about how that conversation is going to go and what value proposition is, I think there is some homework to be done in terms of what the corporate strategy, what are the goals of these large institutions, what type of areas they're interested in or not interested in, what are their stance on investment, what track record do they have. And in most cases, you'll find that if you're getting the meeting, that there is at least an interest from an elevator pitch perspective. So these people are not looking to find out, how to conceal the idea. They might be curious about what you're doing, but it's yours to sell in terms of finding out whether you are creating that value proposition as it fits in the greater picture or not.
Very similar. So I think that I understand your point about potential conflict of interest and so on, but very similar to what Fares mentioned. So we don't look at businesses that are, below, let's say, $100 million in revenue. So there's no real competition there. Yeah. I'm doing also M&A. So the same team is doing CVC and also M&A. We have done. We have two different type of M&As. One is just technology acquisition because you have a technology gap in your portfolio. And then yes, there is potentially there. We buy company early stage. Yeah. But then there is the business acquisition, and there the revenue becomes really important. And when we want to build a new business or incubate a new business from inside is really, really difficult because you need to decouple decision making, you need speed. So what we tend to do as well is divestment, creating new startups, being in the board, finance them, give them enough runway to be able to raise money, and then we let them grow. Yeah. We have just a threshold that is we don't want to consolidate the losses, and then when they go at 100 million level, we buy them out potentially, or we just make a return on investment. That's a model that we adopt too. So there is actually a sweet spot. There is no real conflict of interest. There is a sweet spot between being strategic and making a return on investment. That's what I've noticed.
And I'll just add one thing, and I'll give you an example. WhatsApp. When WhatsApp was acquired, it was a $19 billion acquisition for a company that had 50 people. Okay. Now, WhatsApp is worth a lot more today, but that's highly because it was acquired by Meta, or at the time Facebook. I think there's a correlation to which as a founder you also have to be pragmatic, is what is realistic at your level and what is the potential of the company. The founders of WhatsApp made a lot more than 19 billion by having the stock and it going up and by plugging into the right type of circumstances. I can't say with certainty, but the probability of the same level of success without being under the umbrella of the largest social network would have been a lot more challenging. So I think there's some strategic decisions that have to be made, even when you do have the potential to be more than hundreds of millions. That potential is contingent on the right level of associations.
Yeah, definitely get the founder's need for liquidity and weighing that balance. I'm actually curious, related question, Antonio. You use a lot of data in your decision-making process, and you mentioned this, interesting strategic value that you can provide at all stages, particularly the early stages, kind of incubating and facilitating. How do you think about valuation and pricing the deals that you're pricing, given that you're bringing so much more than capital to the table? Do you often look for things like a board seat? Do you try and exercise any governance? Generally, how do you structure things in such a way where you use your CVC, the nature of the fact you're a CVC, to an advantage?
Well, we, especially in current time, valuations are super important. So, and because we have domain expertise, when I see a term sheet, first of all, I tend to be involved in deals at the inception. So I syndicate deals because I want to be part of the entry price discussion. And even when the entry price is set by a VC, I want to understand what's the logic behind, because I've seen too many valuations that are completely out of charts, especially in the last few years. So we are very sensitive to entry price. And in terms of data, I believe in data, but I believe more in people actually. So I never invest in companies only based on data. And I never invest in companies unless I see people in the eyes. So trust, and as much as it's possible to get trust after 3 months or 4 months due diligence, is actually everything. So the way we actually approach this, especially kind of this asset class that is very high risk, we have a cross-fund investment strategy. We have an early stage vehicle that is off balance sheet, and actually growth funds that are Sony and non-Sony money. And we use the early stage vehicle to get a foot in the door, because I believe that you only get to know a company after you put some money into it. And then the best ones, we double down and we tend to reach a stake of 10% plus. That's the strategy. So data, yes, but I need to get the people, the vibe of the people.
Yeah, well said. Faraz, let's shift gears now to something with a more regional focus. So Meta's got a big focus on communities as a business. It's what you do, right? So if you couple your experience with emerging markets and what you're doing here in this region with Meta's community focus, how do you think about how you can bring their investment strategies to bear on the Middle East and Africa?
Yeah, so I'll give you a few data points that I think are quite striking about the region. So I look after Middle East and Africa, which includes Turkey to some degree. Africa alone, the continent of Africa, by 2050 will generate more youth than the entire world combined. So by 2050, more than 50% of the young people will be coming from the continent of Africa. So as a strategic interest, that's a bit more long-term, you start thinking about getting people on the platform, getting the user habits built in, which in many cases is driving a lot of the large tech companies to accelerate the connectivity process of Africa. So, we have a Africa submarine cable. We're providing almost 30% of connectivity with different touch points. I know other tech companies are doing similar, and I think that strategic long-term view on markets that are going to be our next billion users is very strategic. We will look a little bit more short-term as far as already in terms of usage, the region, Arabic is the second language on our platform after English, surprise to many. And we see double the global average of video consumption here that we see in the global average. So as things head into video, in short or long, we see the region being massive consumption of creator of video. So although a lot of the technological advances might not be spurring out of the region, in terms of consumption, we tend to lead in a big way. And so there's a lot of trends and things, and you see a lot of apps striving here in the region. And then last, which is I would say probably in the midterm, which is a lot of is not spoken about, which is the AI kind of hype and investment. The big discussion around AI is resources in terms of getting talented people who know AI. And I always say this: people worry about job replacement. I say people who know AI will replace people who don't know AI. So start there. Second is energy. Every time you do one of those large language queries, searches, it's enough power to power an iPhone. Each search, each query. So you can imagine the amount of energy that will be required, and that the region enjoys abundance of energy. The UAE is the largest, eighth largest producer of energy, of oil in the world, but it's also in the top 10 renewable energy producers, which people don't talk about. So I think as you prioritize the need of energy and chipset, of course, but the need of energy to power those chipsets, I think you see a lot of dynamics that are evolving around the region that make the region a lot more interesting. The idea of depth of academic institutions, or the idea of having deep talent in a particular country, that's also shifting. I mean, I look at the crowd here, there's probably like at least 20, 25 nationalities. And the region has done very well is to become a really nice hotel room for the top talent around the world. So this convergence, I think, makes the region great potential for the short, medium, and long-term type of investments.
By the way, one point for Africa, we have also launched an activity in Africa. Actually, this year we opened up an office in Kenya, and actually Farouk, my colleague that is sitting there, is in charge of that. And we are completely aligned with what you said. I think 2050 is going to be a massive massive amount of creators, a lot of different cultures. Is really fertile ground for new type of content. So we really want to invest there more and so on. And we are doing this together with IFC. So I think we should have more discussion offline on this.
There are 5.5 million creators in MENA, or self-proclaimed creators in MENA. That's more than the UK, that's more than Germany, that's almost as many as the US. And not all of them are from the region, by the way. It's particularly Dubai has become a hub for creators. Many reasons: friendly immigration policies, COVID fueled a lot of it because the way it was handled. Tax-free, creators struggle paying taxes or figuring out how to pay taxes for that income. And I mean, look, it's a roundabout kind of Instagram moment everywhere you look. That convergence is also making that hub of a media hub. It plays a great part of why the brand of Dubai has traveled so widely and so successfully. So a lot of these convergences that are maybe tactical in the short term, I think in the long term is setting up the region to be a really interesting place when it comes to digital and content creation.
Perfect. Gentlemen, we're at time. Thank you so much for taking part in this. It was a pleasure to meet you both.
Thank you.